Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark. And in today's episode, we're going to continue the conversation around everything that's going on in the world and how it's impacting the mortgage market. But this time, we kind of want to take a look at it. Is it actually a crisis for investors? Or is this actually an opportunity? So I think that's an interesting question. It obviously speaks to a framing of the challenges that are around us. And I just thought we'd be wise to take a slightly deeper dive into that. So it's going to be a shortish episode. So yeah, if this sounds like something that's of interest to you, then stick around and let's get some insight into this. So yeah, as I say, right now, depending on who you listen to, the property market is either falling apart or full of opportunity. So rates are moving, lenders are repricing, global events are impacting everything. So the question is, are we actually in crisis or is this actually an opportunity? And the honest answer is, well, it's probably both. It just depends on how you are positioned, I guess. So let's take a look at this. So let's look at the crisis side of the conversation then. So debt has changed. You would have seen in the press, no doubt, if you're going through a refinance or anything like that, the cost of money has gone up. It's gone up significantly, around about 1% for most mortgage lenders. So that's the highest that it's been in the last 18 months. So, that is not insignificant in itself. Deals that once worked possibly don't work now. So higher rates also mean tighter margins. So if you're in a position where you have to refinance, then you may find that your deal is less profitable given the interest rates that are available at the moment. And a lot of investors are just starting to now realize that the old modern model doesn't stack. So there's that eternal question, is buy to let dead? Well, as mortgage interest rates squeeze, then that becomes much more pertinent as a question. Okay, so number one, the cost of debt has definitely gone up. Two, so refinance risk is real. So as a byproduct of this, and we may not see it immediately, but we may find it creep into the market, is valuations no longer support. So you can have down valuations. So what am I talking about when it comes to a down valuation? A down valuation is really where something is being valued at one stage and then valued at a later stage, and that value is now lower than the original sum. So this isn't a question of it just hasn't made your assumption. It is actually a case of it actually gone down in value. And that can happen when mortgage interest rates go up because people are prepared to pay less for the property. Therefore, that will influence because of the margins and so on and so forth. Rental stress tests. So as the mortgage interest rates go up, then the mortgage payments go up. And as the mortgage payments go up, then the rental stress test shifts upwards as well. So if it's in a limited company, we know that you need to do 125%. So the rental income needs to be 125% of the mortgage. So obviously if the mortgage goes up, then that 125%, the rental income needs to go up and so on and so forth. And you may find that some of the lower yielding properties no longer meet the rental stress test. So that's something to be aware of as well. And then just lender appetite changing, really. We've seen 1,800 products, I think it is, come off the market recently. So that's something to be aware. Lenders are pulling back. Are the loan to values going to be there that are needed and so on and so forth. So, that's just stuff to bear in mind in terms of, is this actually a crisis? And then volatility. So that creates paralysis. So very often people just sit and wait. Can be sitting on cash. Cash is then not performing and that's not generating you an income and so on. And then just being non-committal in the decision making. So uncertainty can slow the decision making process. And that in itself can feel like a crisis, that you just can't get to your goal quick enough in that term. And then we've got, obviously, as the main driver, the driver to this is going to be global events. So that's the US-Iran conflict, as well as other conflicts going on in the world. But in particular, that one is the main one. We're 5 weeks into that now, or we're in week 5. So that means, there's no telling how long this is going to go on for and the longer term impact of this. So I think it's fair to assume that there's not going to be any quick fixes. The market's not just going to bounce back after this. And I think we need to be prepared for things to cost a bit more or a lot more in the short to medium term. I suspect it's going to be the best part of 18 months before there's a degree of normality again, just because of the influence or the disruption in the oil supply and the impact that's going to have across all products and services around the world. Not just in the UK. So we're now in a market where global politics directly impacts the mortgage rate. So just be aware of that. So yes, if your deals are tight or highly leveraged or dependent on perfect conditions, then this market can very realistically be a problem. Okay. But let's not just focus on the downside. As I said, there's two sides to this conversation. Is this crisis or is this opportunity? So let's look at the opportunity side of the conversation then. So first and foremost, if people are making fewer decisions, then there's less competition about. So if there's less competition, there's fewer buyers, less aggressive bidding processes, and you may find that you might get better deals as a result of that. So when people pull back, opportunities tend to appear. So this may be if you're in a position where you're cash rich or you've got opportunities on the table, this could be your cue to go back and renegotiate. So let's look at that as an opportunity. More motivated sellers. So I spoke about more deals being done. So developers may need to sell assets at a reduced margin because they're under pressure to get deals done. Other landlords looking to exit because their margin getting squeezed. That, coupled with the increase in regulation, means that they may want to exit the marketplace. Now, that may be an ideal opportunity for you as an investor to take those properties off those landlords. You might find other ways to sweat those assets a bit different, or simply you're prepared to tolerate the level of yields that the exiting landlord is not. It doesn't necessarily need to be complicated. And as I said, deals are becoming more negotiable. So if there's not a queue of people waiting to buy, then there's more room for negotiation. It then becomes a buyer's market. So you don't find opportunities in easy markets. You tend to find them in uncertain ones. So it will create more opportunity off the back of that. So better buying discipline. What I would say there is investors forced to be more selective. Now, in regards to property deals when we were in a low interest rate environment, almost every deal is stacked because the cost of funds were so low. As that gets more pressure, and those, I guess, that bought in low interest rate environments and they weren't particularly strong performing assets, are going to feel this pinch right now. But what this does mean, if you're going into an asset in this current environment, then you're certainly going to be thinking twice about whether you want to go into low margin deals, given the environment that we're in. So deals ultimately and fundamentally need to stack properly, which is the way that it should be, really. So this market tends to filter out the bad deals and the bad habits and makes it a leaner process. So that's certainly a positive in there. You're less likely to move blindly into a bad deal with the environment we're in at the moment. Creative structuring becomes more valuable. So leveraging bridging, development finance, and we've covered those topics in great depth in previous episodes. So if you're unfamiliar with those, then please go check them out. Vendor flexibility. So we've spoken at length around things such as vendor finance, whereas you can work with the vendor to come up with something a bit more creative in the way to get the deal done. So you don't have to necessarily lean on development, bridging, mortgages, etc. to get a deal done. It's obviously dependent on the vendor's circumstances. However, in the absence of a queue of people wanting to buy it and just buy it cash and so on, vendors are probably going to be a bit more open to some suggestions, especially if that means that they can still hit their premium that they want to get off the back of it. So when markets tighten, structure matters more than ever. So just make sure that you can think of how you can actually deliver against those structural things in terms of the deal itself. So if you're well capitalized, disciplined, and realistic, this market can be a very good place to operate in that sense. So in answer to the question, is it a crisis or an opportunity? It's not crisis or opportunity. It's just a set of circumstances. And as I say, it depends on which side of that conversation you sit. It's going to look different for different people. So just please bear that in mind. So tight deals equals a crisis. Strong deals equals an opportunity. This market doesn't create problems. It just simply exposes them. And those problems, for example, are people who are over leveraged. Again, there's a conversation to be had there. Poorly planned exits are now starting to fail because of interest rates or weak margins, so margins are actually disappearing altogether. But for investors who understand risk, structure, and exit, this is where momentum can genuinely build as well. So what are some of the practical takeaways in an environment such as this? Well, we've sort of touched upon these in previous episodes. Stress test everything. So stress test against higher rates, stress test against lower values, stress test against longer timelines. The longer you're in or you're borrowing money for, the more it's going to cost over that time. Focus on your margin. Okay, margin isn't profit, it's protection. Plan the exit first if you're going into bridging or development. If you don't understand the exit, then don't do the deal. It's as simple as that. And ignore the noise. The headlines don't build portfolios, decisions do. Okay, we see a lot of bad press or a lot of press around what's going on in the marketplace at the moment. And some of the numbers we see are massively distorted, almost like clickbait. So stay away from the noise as best you can. Obviously, keep up to date with what's going on in the world. Try not to get dragged into the clickbait, doom and gloom headlines. As we've already discussed, there is opportunity to be found in a market such as this. So just some closing thoughts and remarks. Every market feels uncertain when you're in it. But the investors who succeed aren't the ones waiting for clarity. They're the ones who understand how to operate without it. And this market isn't asking whether it's a crisis or an opportunity. It's asking whether you are prepared. So if that sounds like you, then go ahead and grab it. Go check it out. Go find those deals. And if you want to talk to us about how you can potentially fund any of those deals, then please do get in touch. I hope you found that episode useful, and I will look forward to speaking to you in the next one. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.